Matt, I was listening to you on a podcast recently, and I know you have a $6.5 million Bitcoin prediction in the next 20 years. What needs to happen for Bitcoin to go from where it is today, I think close to $80,000 to 6.5 million?
Yeah, well, the only thing that I think could stop that is if governments around the world stop spending too much money and printing money. And I think that's highly unlikely. I think the technology is inevitable. I think, as I mentioned at the start of this, the technology is superior to gold. The learning process in Bitcoin over the last 15 years has suggested more and more people realize that every year.
That's Matt Hugin laying down the entire foundation in one breath. He's not talking about a quick pop or a flashy catalyst. He's saying the same pattern keeps repeating. Governments spend, currencies get questioned, and people keep learning what Bitcoin actually is. The reason he can even say a number like $6.5 million is that he thinks this is a long, slow migration, not a short, dramatic event.
What the precious metals rally is telling you, not the last few weeks, but the last year, is that the world is worried about fiat currencies. The world is interested in self custody. Those roads eventually lead to Bitcoin and crypto. I've been telling people when I go to institutional investors a year ago, I was telling them about Bitcoin being digital gold, and it was 10% of the gold market. And that's pretty substantial. And you had to convince them that it would go from 10% to 20% of the gold market.
He's basically saying gold is acting like a thermometer for anxiety about money. When trust in fiat gets shaky, people look for something they can control. That's where self-custody becomes more than a nerdy feature. It becomes a motive. And once that motive kicks in, he sees Bitcoin as the next logical step for institutions that already understand gold but want something that fits a digital world better.
Yeah, well, eventually all roads lead to Bitcoin because it is a superior tool for what central banks are trying to achieve. The primary difference between Bitcoin and gold from a self custody perspective is that when you buy gold, you can self custody it while you hoard it. You can keep metals in vaults in your countries. But as soon as you want to use it, as soon as you want to pay for something, send it somewhere, balance trade, you lose that self custody. You rely on intermediaries. You have to put it on a train, a plane, a boat.
This is one of the most important points in his whole argument because it's not just vibes, it's mechanics. He's saying gold works fine as a symbol, but it gets awkward when you actually need to move value and settle value. That's where intermediaries show up, and that's where control can slip. If the world is heading toward more self-protection and less trust, then the asset that stays under your control all the way to settlement has a real advantage.
The difference with Bitcoin is that you get to self custody it all the way through to settlement, up to the moment that it transfers from you to someone else. You're in complete control and no one can hold it. So, as central banks sort of mature in their understanding of Bitcoin, and as the world moves to where gold and hard currencies are used more for settling transactions, I think they're going to come to Bitcoin. Eventually, I think they'll own more Bitcoin than gold. How long will that take? These guys move on a glacial pace, right? You're talking about 10 years, you're talking about 20 years, but I do think the roads lead there.
That glacial pace is the tell. This is a decades argument, which matches the timeline of a multi-million target. He's not saying central banks wake up tomorrow and buy. He's saying they're slow, but their direction can be huge. And if central banks eventually treat Bitcoin as a serious settlement asset, the demand story stops being about trends and starts being about the structure of global finance.
But as you said, the genie is already out of the bottle. There are already ETFs. BlackRock's most profitable ETF is now a crypto ETF. They're not going to turn anti-crypto. You have JP Morgan, you have Bank of America, you have Morgan Stanley building on crypto. They were not going to go back to the Gensler era rules. But I do think it changes the shape of the coming bull market. Again, if clarity passes, I think it's a fast market. If it doesn't pass, it's a slow market.
Here he's drawing a line between direction and speed. He's saying the infrastructure has already crossed a point of no return, especially with big-name financial players like BlackRock and others building products and exposure. Policy can speed up the timeline or slow it down, but he's arguing it's not likely to reverse the long-term trend. And that matters because a $6.5 million call can survive delays, as long as the path still points forward.
Now, the constrained volatility is hugely helpful for the audience, the primary audience that Bitwise serves, which is the institutional community. They can't touch something with a 60 vol. So one of the most effective talking points that I bring into those conversations is I show people slides that look, Bitcoin is actually less volatile than NVIDIA. Do you own NVIDIA? You do. So can you own Bitcoin? You can.
So, putting it all together, his $6.5 million target hangs on a few connected ideas: the world's growing anxiety about fiat, the desire for self-custody, Bitcoin's edge over gold when it comes to actually moving and settling value, the slow but powerful gravity of institutions, and the way maturing market structure can make Bitcoin easier for conservative capital to own. He's not presenting it like a guaranteed straight line. He's presenting it like a long migration where the boring parts are part of the process and where the biggest shifts come from who eventually decides they need exposure. After hearing those 6 moments back to back, do you buy the idea that this plays out as a decades-long adoption wave that could justify a multi-million Bitcoin? Or do you think the $6.5 million target still feels like a number that ignores too many risks?